Hello, and welcome to Calling Monster Finance. It's September 12th, 2025. Today, the U.S. markets closed out a record-setting week with a session of clear divergence. While the tech-heavy Nasdaq composite climbed to yet another all-time high, the Dow Jones Industrial Average pulled back, and the broader S&P 500 finished nearly unchanged. The market's tone was one of consolidation and watchful waiting, as investors paused to digest recent gains. The day's trading was shaped by a tug-of-war between several key forces: persistent optimism about a potential Federal Reserve rate cut, a sharp drop in consumer confidence, and significant moves in individual stocks driven by merger speculation and corporate earnings. Coming up, we'll break down the narrative behind today's mixed performance, analyze the macroeconomic data that's creating a disconnect between Wall Street and Main Street, and recap all the essential closing numbers you need to know. The main story on Wall Street today was a split decision. The technology sector once again demonstrated its leadership, propelling the Nasdaq composite to a new record close, up 98 points or 0.44%. This strength was fueled by significant gains in mega-cap names like Tesla, which surged over 7%. This optimism was not shared across the entire market. The Dow Jones Industrial Average, which represents a broader slice of the U.S. economy, retreated from its own record high, falling 273 points or 0.59%. The S&P 500 was caught in the middle, finishing the day almost perfectly flat, down just 3 points. This performance highlights a market that is becoming increasingly selective. A major catalyst in the corporate world was the continued speculation around a potential merger in the media industry. Reports that Paramount Skydance is preparing a takeover bid for Warner Bros. Discovery sent shares of Warner Bros. Discovery soaring for a second straight day, closing up a remarkable 16.70% on heavy trading volume. But while M&A activity provided a boost, a dose of economic reality came from the University of Michigan's latest consumer sentiment survey. The preliminary reading for September showed a surprisingly sharp decline, indicating that households are growing more concerned about inflation and the job market. This data introduced a note of caution, creating a stark contrast between the record-high valuations in the stock market and the growing anxiety among consumers. This very disconnect defined today's trading session, as investors balanced bullish momentum with emerging economic headwinds. Let's take a deeper look at the two primary forces that shape today's market dynamics. First and foremost is the Federal Reserve. Although the central bank was silent today, its anticipated actions were the dominant theme. The market has moved beyond simply hoping for an interest rate cut at next week's policy meeting. It is now treating it as a near certainty. Futures markets are pricing in a probability of over 95% for a 25 basis point cut. This conviction has been the primary fuel for the recent rally to all-time highs. However, this also creates a significant risk. With the best-case scenario already priced into stocks, there is very little room for a positive surprise from the Fed, but considerable potential for disappointment if the central bank's message deviates in any way from the market's dovish expectations. The second key driver was the clear and growing divergence between Wall Street sentiment and Main Street sentiment. While the S&P 500 hovers near a record close of 65.84, the University of Michigan's Consumer Sentiment Index fell sharply to 55.4, its lowest reading since May. The report's director noted that consumers are expressing rising concerns over business conditions, the labor market, and inflation. A notable portion of respondents specifically mentioned trade tariffs as a key worry. This disconnect is critical because it suggests the foundation supporting these record equity prices may be less stable than it appears. The market is pricing in a perfect soft landing for the economy, but the data from consumers indicates they are experiencing a bumpier ride. Adding to the discussion on trade policy, President Donald Trump commented today on his administration's decision to impose a 50% tariff on India related to its purchases of Russian oil. In an interview, the president stated, "I put a 50% tariff on India because they're buying oil from Russia. That's a big deal, and it causes a rift with India." This commentary provided a direct link between White House policy and the real-world impacts felt by U.S. corporations. On the very same day, luxury furniture retailer RH saw its stock fall after it cut its annual revenue forecast. The company's CEO explicitly blamed the polarizing impact of tariff uncertainty for the downward revision. This creates a clear line from a specific policy statement to a negative corporate earnings revision and the decline in consumer confidence we saw in the Michigan survey. Meanwhile, two significant news items involved Tesla CEO Elon Musk. First, in response to investor concerns about his personal safety, Musk posted a direct acknowledgement stating, "Definitely need to enhance security." This highlights the significant key person risk associated with the company. At the same time, the market continued to digest the details of a newly proposed performance-based compensation package for Musk, which could be worth over $1 trillion if all ambitious targets are met. The plan is tied to goals like increasing Tesla's market capitalization to $8.5 trillion. The discussion around this massive incentive plan helped fuel a strong rally in the company's shares, which gained 7.36% today. The market, it seems, was more focused on the potential for unprecedented reward than the associated risks. Turning now to corporate earnings, we saw how company-specific news contributed to the day's divergent theme. First, software giant Adobe reported its third-quarter results after the bell yesterday. The company delivered a strong report, surpassing analyst expectations for both revenue and earnings, and it raised its full-year guidance, citing momentum from its artificial intelligence products. However, despite this positive news, Adobe stock closed down 0.34%. This is a classic example of a sell-the-news reaction, suggesting that investors' high expectations were already fully priced into the stock before the announcement. In sharp contrast, we have the report from luxury retailer RH. The company's quarterly results missed analyst estimates, and more importantly, it lowered its revenue forecast for the full year. Management did not mince words, directly citing the polarizing impact of tariff uncertainty and the worst housing market in almost 50 years as the primary reasons for the cut. This report serves as a clear data point showing how macroeconomic headwinds, particularly trade policy and a challenging housing market, are directly impacting corporate performance in certain sectors. To truly understand today's mixed market, we need to look beneath the surface of the major indices and at the performance of the individual S&P 500 sectors. The divergence was stark. On the positive side, the information technology sector gained 0.45%, providing the primary lift for the Nasdaq. It was joined by defensive sectors like utilities, which rose 0.56%, and the consumer discretionary sector, which was up 0.57%, largely thanks to the powerful move in Tesla. However, the weakness was much more widespread. The healthcare sector was the biggest loser, falling 1.13%. Economically sensitive sectors also struggled, with materials down 0.97% and industrials declining by 0.82%. This weakness in cyclical areas of the market explains the poor performance of the Dow Jones Industrial Average and the Russell 2000 Index of small-cap stocks, which fell over 1%. In essence, today's market was a story of narrow leadership. A handful of mega-cap technology and growth stocks managed to keep the Nasdaq and S&P 500 afloat, while a broader swath of the market, particularly those companies more exposed to the real economy, experienced selling pressure. Now, let's recap the closing numbers for today, September 12, 2025. Both the major U.S. indices. CAL, the Dow Jones Industrial Average fell 273.78 points, or 0.59%, to close at 45,834.22. Both the S&P 500 index slipped just 3.18 points, or 0.05%, ending the day at 6,584.29. Collisions of Nasdaq Composite added 98.03 points, a gain of 0.44%, to finish at a new record of 22,141.10. And the Russell 2000 index declined 24.47 points, or 1.01%, to close at 2,397.06. Turning to key commodities, currencies, and yields. The CBOE Volatility Index, or VIX, was up slightly at 14.76. The US dollar index rose to 97.61. The US dollar to Japanese yen exchange rate was 147.65. Both the yield on the 10-year US Treasury note increased to 4.06%. With crude oil futures settled at $62.60 per barrel. Brent crude futures closed at $66.87 per barrel. Gold futures ended the session at $3,680.7 per ounce, and the price of Bitcoin stood at $116,087.97. Finally, let's look at the top 5 stocks by trading volume today. Number 1 was Tesla, which surged 7.36%. Number 2 was the SPDR S&P 500 ETF, which was down 0.03%. Both few 3 was the Invesco QQQ Trust, which gained 0.44%. Number 4 was NVIDIA, closing up 0.37%. Collaborations, and number 5 was Oracle, which fell 5.09%. In summary, today's session was defined by consolidation and divergence. While the technology sector continued its impressive run to new heights, broader market weakness and a concerning drop in consumer confidence served as a reminder of the economic headwinds that persist. Investors are now squarely focused on next week's Federal Reserve meeting. The market has priced in a rate cut with a high degree of certainty, making the central bank's accompanying statement and economic outlook the most critical variables to watch. Any deviation from the expected dovish tone could introduce significant volatility. If you found this analysis helpful, please hit the like button, subscribe to our channel, and share this video with your friends. The content provided on this channel is for informational and educational purposes only and does not constitute financial, investment, or legal advice. All investment decisions should be made with independent due diligence and in consultation with a qualified professional. While we strive to ensure the accuracy of the information presented, we cannot guarantee its completeness or correctness. Any risks or losses resulting from the information on this channel are solely the responsibility of the individual. The views and opinions expressed in this video are those of the speakers and do not necessarily reflect the official policy or position of this channel. This content is not an offer or solicitation to buy or sell any financial instruments.